The pullback we've all been waiting for is finally here. The S&P 500 is testing the previous all-time high, down about 2.25%, and if it closes the election gap, will be down about 4% roughly. This aligns quite well with the average statistic of about 1/10% correction and a handful of 5% pullbacks in any given trading year. But will the next big event, Nvidia earnings this Wednesday, make things worse? There's quite a large call wall that's sitting at about 150, basically the all-time high, that could pose a little bit of a threat. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame chart, talking about candle structure and location as we always do. In terms of structure last week, solid red-bodied bar with a pretty weak close from the sellers down on the lows of the weekly range. I'd definitely consider that bearish. If we're thinking about location on the bar-to-bar count, we do see a substantial higher low as well as an equal high, if not an ever so slightly higher high from the Monday morning gap up. So generally speaking, on the bar-to-bar count, I'd be a little bit more neutral than outright bullish or bearish. But if we add in the context of the overwhelming trend here being up, I think we still want to lean into more of these bullish outcomes on the higher time frame weekly. If you recall from last weekend's episode, we had talked about lows, higher lows, soft higher lows, firm higher lows. Along the way, we had equal highs here, higher highs, and point being is that the pullback is coming from the highest high in the trend count, which basically meant that we could afford a weekly higher low if a pullback were to emerge. And the level that we had been discussing on the weekly chart was right here. The previous all-time high would have been the best place for a higher low to emerge. So if we just ask ourselves the question, did the weekly chart dramatically violate that level? I would have to answer with a resounding no. Is it still possible that you get a higher low from here to here? I would have to answer with a resounding yes. So I'm not really that bearish on the weekly chart. I think this is a higher low pullback buying opportunity more so than anything else. If we bring out some of the additional supporting evidence, remember if we come in from the low, that's the August 5th panic, to the new all-time high, the 38.2 is smack on these lows and the previous weekly breakout point from back here. As long as we're above that in the grand scheme of things, even if the pullback does not hold the previous all-time high here, this is still bull flag consolidation, and over time, we'll look for that to resolve in the upward direction. If we bring out the weekly anchored VWAPs, we're still above the entire cluster, and this is providing some confluence near that Fibonacci 38.2. So all set from that point of view as well. What do we see here from a volume profile perspective? Let's drop this down to a 6-month chart. And then we'll just zoom like such. That's fine. We'll bring this down. Thanks for bearing with me. If we take a look at this volume shelf right here, that's exactly what we've pulled back to. And again, this is not really much of a surprise. We know that as we're pushing into new all-time high territory, of course there's going to be less volume. But as we retest this high volume shelf, is it possible that it acts as support? I think the answer is yes. And as we had talked about as well, the real line in the sand is still down here. This high volume shelf is the weekly breakout level. As long as we're staying above that on the weekly time frame chart, yes, we might flip to a little bit more neutral if we get some deeper consolidation that looks like this, but generally speaking, the uptrend is still very much so intact here. Let's drop this down to a daily time frame chart. Let's start to get a little bit more granular, because this, of course, is where we start to run into some issues. Let's begin by evaluating this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 595.63, which unfortunately does imply a little bit of a lower high from the all-time high. If we're contained by the lower bound, the number's at 575.94, which still implies a higher low on the daily time frame chart, which is slightly bullish. However, of course, it would mean that we close the election gap. So if we're thinking about the general trend here, just like on the weekly time frame chart, right, we do have an uptrend. We have highs, we have higher highs, we had lows, we had higher lows. Remember, there was a minor daily downtrend happening here. So this is the last low in the sequence, really. Is it possible that we close the election gap and still have a higher low from here to here? I think the answer is yes. As we're thinking about the election gap, the lower edge of the weekly expected move, I think we should also tie in that we do have the daily 50 SMA to meet us there as well. So this is a very big and important level for the upcoming week's worth of trade. This 576.75, 575.90s area, this 50 SMA, which is currently sitting at 575.60. Huge level on the daily time frame chart as we move forward. The weekly line in the sand is still down here. That's that 564 level we were just referencing on the weekly chart. We may have called it 565 in the past. Let's not split hairs on the weekly. So this assumes that the market is going to come down and close this gap all the way. Do I think it's fair to make that assumption? I'm not quite convinced. What you'll see already into the close of day on Friday is that a lower wick started to emerge here. And I'd also call out, it might be very, very faint on your screen, but we also have had 584.50 on our charts. This high from the gap up back here technically represented one data point. The bulk of this consolidation and balance, the top end of that range, was actually at 584.50, and we'll see that more clearly on the hourly chart in just a second, and we did start to get a lower wick off of that level. So did we push into the election gap? The answer is yes. Did the sellers accelerate into the election gap? I would say no. This is still a retest of the previous all-time high, and the main objective here going forward is to look for price acceptance back above 586. If early on this week we can get price acceptance that's staying here, then it's very possible that we close the overhead gap from Thursday into Friday, right? Because let's not forget what happened here. As of Wednesday, we were describing this as a 4-day balance range, and things were looking pretty boring. Thursday, we actually got a breakdown and a close underneath the balance range lows, which we've been tracking around this 595.25 area, right? We had made note that we looked below and we failed that a couple of times on Tuesday as well as on Wednesday. Well, Thursday was successful in terms of closing underneath. Now, the next thing we can say is, where did we open up? We opened at the open of the Wednesday election morning, follow-up to election day, right? The gap up there, and we didn't find any buyers. So intraday, could this be overhead supply weighing on price to the downside on a liquidation break into a key area of support? I think the answer is yes. We're not really seeing a big shift in trend on the daily chart or the weekly chart. We have key areas of support which will maintain a daily uptrend. And I think that the only risk here for possibly falling into a daily downtrend is if we do find buyers and support off of the previous all-time high, this level right here, get a counter trend move relative to this breakdown in the upward direction. Let's say we close the gap and reverse off of this. If on the daily chart you see this setup right here emerge with a big time lower high on a gap fill reversal underneath 592.75, I think that's a situation in which I would say, okay, at the previous all-time high, I would look for price to move through, set a lower high, and then all of a sudden we have bearish trade opportunities on our hands for risk reward that might look something along these lines right here. When we get to this daily line in the sand, as we had started off the daily chart analysis with, I definitely would not be bearish there. I would be starting to think about, is it possible that buyers step up here and try to get new money long positions built out near the daily 50 SMA, the lower edge of the weekly expected move, the election gap close, all of those things that we just discussed. And once again, this zone starts roughly at 576.75 as the top of the gap. And then the sort of level here, if you want, let's just drop it down to the hourly chart so we can see this with more detail. Let me zoom in. There's a couple of things I want to share with you. So this level right here represents the top end of the multi-day balance range. We just ever so slightly started to break out over it prior to the election, right? And that level is at 575.50. Remember also, I was telling you I would point out why we were talking about 584.50, which is probably very faint on your screen, but rejection, intraday rejection, sort of topped out near that, but intraday rejection, right? You can see that's where the market started to find a little bit of a footing after looking further into the election gap back here. So let's start to talk about this from a pattern perspective, a trend perspective here on the hourly time frame. Massive move to the upside, momentum rally to the upside. Then we start to get this distribution, right? We had talked about on Wednesday, look below and fail, and how the buyers had an opportunity if we could stay over that level at 595.25, that there was possibility for consolidation and a breakout over time. That, of course, did not happen, and the biggest signal was the lower high on Thursday underneath that level. Once it became clear that the sellers were able to keep price below, and of course, Jerome Powell's commentary on Thursday, it certainly helped the sellers. It did not help the case for the buyers. Once that took place Thursday at 3 p.m., it became clear that there may have been a pullback. Now, a pullback this deep, gap and go, and continuation into the election gap, that wasn't really on my bingo card. I was looking for a bit of a stronger response from the buyers here. Didn't take place. Was looking for a stronger response here directly at this area of support. Previous all-time high didn't really take place. So we have to give credit where credit is due. Obviously, if this is a sort of double top happening up here, as we described on the daily chart, if we go for a gap close, reject off of it, equal low, the door is open. We're rejecting sort of the neckline of this hourly trend reversal. If the market wants to put in some sort of support around, if new buyers do step up around this 586, what I would be looking for early on in the week in terms of pathing here is a higher low back above that level. I would want to be long here with the expectation that this is a possible trade, right? This is an idea, this is a thesis, tight risk, decent reward to close the gap. Up here, you would have to reevaluate. Is it possible that sellers step up there and provide that reversal we were just describing? Of course, that's possible. So that's your initial risk reward. Where would things be incredibly bullish? Well, obviously, if we got some sort of early week opening drive and just sort of consolidation here, and then a breakout over this level, really the sort of upper consolidation, if you will, at 595.25, if we were to get over that level, then absolutely, this is just bulls on parade. I would be thinking about new all-time highs. That is absolutely extended through the upper bound of this week's expected move. So I would typically say that's probably lower probabilities. The one thing that might change this, of course, are those Nvidia earnings coming out on Wednesday after the close. The downside outcomes, right, if we are just getting consolidation here, I would be on the lookout early on in the week for any sort of Brigade bolts underneath the low of day from Friday. If we do get that, because this is a gap technically, there's not a lot of structure there. And of course, the pretty straightforward outcome should be for a continued attempt to close the gap down towards that key level, the key daily zone we were just talking about at 576.75. And of course, risk reward along these lines might look like, consolidation here. Here's the little intraday Brigade bolt. I would pause once at 579.75, then look for the full completion, and your risk wants to be somewhere along these lines and your reward somewhere along these lines, right? So that is the downside trade early on in the week. And I would really just have to call for the main arbiter of price being the previous all-time high, 586 here on the S&P 500. Let's bring out our intraday anchored view apps and see what else we can learn here. Notice that we are getting tangled up with two of the important anchored view apps. If we come back, it's the top end of the previous balance range. It's the bottom end after this was really Microsoft earnings gap down that caused this, right? So this anchored view app, these are clustered here. If we can resolve this zone generally to the upside or the downside, that will tell us something. And as we were making note about the daily lower high threat, this anchored view app from the election gap up and the latest all-time high is going to be barreling down early on in the week at that 592.75 gap fill reversal resistance area. So I think the pathing still stands. No major changes from that perspective. Let's come in here with the Fibonacci's from the low up to the high, just calling out that 38.2 has been violated to the downside. 61.8 is confluence with the bottom end of this range here. That's that level we were just describing at 579.75. So worth an intraday look, but ultimately the target should be that full gap close if the bears are accelerating underneath the anchored view app cluster and the previous all-time high, as we just mentioned. If we take this off, I do want to measure, just for the sake of seeing where we're at, from the top to the bottom here, any confluence out of that, the 38.2 is the high of day from Friday. So if we are accepting here and sort of rejecting underneath, let's say that we don't even close the gap. Remember that an unfilled gap here in the case to the upside would be more indicative of stronger sellers persisting in the market. If that's what we get here, technically it's bear flag consolidation from a Fibonacci perspective with that 38.2. So that's your hourly look. Let's take it on over to the market internals. If you're not familiar with the market internals dashboard, check out the video tutorial in the top right-hand corner. And this is where things get fun. This is where things get really, really fun. You heard me say on the weekly chart that I believed it was just a pullback, right? You heard me say on the daily time frame chart that there's still plenty of opportunities for higher lows. Let's take a look at the market internals specific to the Friday session. Friday is when we had that gap and go, big downside movement. What were the market internals doing at the exchange level? Question becomes, did we have substantial volume outflows on that individual session? The answer is no. Were we stuck in trend lower zone all day on that session from the advanced decline line? The answer has to be no. Was the index score strong intraday? The answer is absolutely yes. Very, very weak intraday index score here. However, the main purpose of coding this indicator was to gauge intraday, right? This measures from the opening print. So of course it's going to read red on a big downside day like that, right? Or it should if you're going to have confidence on the intraday. But at the exchange level, you're not really seeing huge participation. What this would indicate to me is actually concentration in the heavyweight components of the S&P 500 that actually cause it to move, right? So it's not a broad-based breakdown here. It's a really concentrated breakdown, which, as we know, Nvidia sort of broke down aggressively on Friday, down roughly 2%. that was a huge driver of all the downside. So this is adding up here. If we take a look at the cumulative build out of the tick, anything substantial there? Absolutely not. Remember, we're looking at negative 5,000, positive 5,000, not even close. Negative 1350 into the close on that Friday session. Net volume flows on the week weren't even substantial. Remember that you want plus or minus 500,000, or excuse me, 500,000, 500 million. And we're just shy of that, 465, right? So with this breakdown on Friday, are we seeing massive participation to the sell side across the exchange level? The answer is no, which still gives me the confidence back on something like the daily or heck, even the weekly time frame chart to say, I'd prefer to be a pullback buyer here still. We've been waiting for this. We talked about this in last Saturday's video. We had said, hey, if the market pulls back to close this gap, remember there was a small gap here. If we close this gap, great, looking for a higher low. If we come into this level, great, looking for a higher low. This is what we were talking about last Saturday. If we come back to this level, we're still looking for a higher low. Well, it's time to put our money where our mouth is and start looking for that higher low at this 586. I'm seeing evidence here that would suggest it's very possible that buyers start to step up. You're not seeing an overwhelming amount of sell-side activity at the exchange level. If I come on over to the market profile, this is the Russell. Let's jump on over to the ES. One thing I'll point out here is twofold. First of all, if you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. But generally speaking, notice how we have an extremely poor high here on that Wednesday session. It's very possible that that needs repair at some point in the future. The next thing to point out is that we have an incredibly poor low on the Friday session. So what does this mean? It means it would not be unreasonable to me if the market came in, repaired the poor low, found acceptance here. If we can keep this value low and then rally to close strong, let's say on Monday or Tuesday or something like that, over the top of this value area, that to me would indicate that these are new money buyers stepping up here, not new money sellers. So yes, value did move lower with price here on that Friday session, but if new money buyers are getting involved, we want them to have entries as close as possible to the previous all-time high retest. If this is indicative of that, and we'll only know when and if, I should say, price accelerates to close, let's say on Monday or Tuesday, above this area, again, 59.10 roughly, 59.12 roughly here in the ES futures. If we can close Monday above that, and I would tend to think things are looking pretty good for a pullback buy opportunity here based on volume profile and where the commitment from those buyers are. If we jump back on over to the platform here, we could take a look at the NASDAQ because unfortunately for the NASDAQ, this is where some trouble starts to emerge. There is some relative weakness over on the nasty NASDAQ. So QQQ weekly time frame chart, as always, candle structure and location. What do we see? Very similar to the S&P 500, solid red-bodied bar, really weak close from the sellers. On the lows of the weekly range, we do still have a bar-to-bar higher low, as well as a higher high, nuanced. Maybe you would just call it an equal high. But this is the all-time high as well, right? So technically, we're pulling back in the overall trend count from the all-time high, the highest high in the trend count. We have lows, higher lows, soft higher lows, firm higher lows. The only difference here is that the NASDAQ, unfortunately, did not, or was not able to, I should say, provide a weekly close over this all-time high or over this cluster of consolidation right here. As we'll see on the daily time frame chart in just a second, much more of the election gap has already started to close, and we've even lost that round psychological number at 500. So I'm a little bit more concerned about the NASDAQ in particular. Still pretty optimistic for the S&P, but the NASDAQ, if it remains weak, will provide a headwind for the S&P 500. If we take out the Fibonacci's from the bottom end of the move, how do we fare in terms of the 38.2, still well above. I'd still argue we're well above the weekly line in the sand here, which is the neckline of this double bottom from back here. So there's still some wiggle room. It wouldn't be great to provide some equal lows. Ideally, we find some sort of higher low, but it's not the end of the world yet on the QQQ weekly chart. I'd say the biggest tell for some sort of big old, fake breakout, new all-time high that rejects would be if we're underneath this neckline zone that we had just described here, which is much closer to 480 for round numbers sake. Let's quickly come in with the weekly anchored VWAPs, and you'll notice that these are pretty much confluent spot on around that 480 zone. These are slightly lower around 476.95, 477, so they're going to slowly creep up over time. If we quickly throw on the weekly volume profile, let's take a look here, and we should probably drop this as well down to something like a 6-month chart will do. Let's take a look at this together. There we go. So your high volume shelf, unfortunately, did not act as support. So that is, again, sort of small red flag number one. It is possible still that this high volume node, it's actually the point of control when we're looking at this amount of price data. This point of control still can act as that higher low, or at least the zone to keep equal lows, and the weekly chart bullish by staying above the neckline we had just mentioned. The point of control is technically at 485 here, 485 on the right-hand side. Let's get back on down to the daily time frame chart, though, QQQ, and see what's going on with the weekly expected move. Let's take a closer zoom. Here we are. So the expected move is this box right here. Upper bound is going to be at 508.35. Lower bound is going to be at 484.72, implying a lower high and an equal low. That is another red flag here on the QQQ. So unfortunately, the daily trend is not really going to be preserved as up if we are going to test the lower bound of the weekly expected move. It's more so closely in line with that weekly higher low line in the sand, which we were talking about 480. Technically, I would use this level right here, if I'm being quite frank, at 485. It was that point of control that we just saw. But generally, what's the differences? What are the differences between this chart and the S&P 500? Well, the most obvious one, as we've already said, is that we're underneath the previous all-time high. But if we just look at this chart in reference to the election gap up, which was this move right here, notice that we've already retraced, I would say, more than 2/3 of that gap. So it really boils down to a full gap fill reversal here off of 492.50 in the QQQ if the broad market is going to maintain more of a bullish stance. If we can find support over the top end of this range, close the gap, find buyers here, then great. Technically, you have the opportunity for a daily higher low. Just like the S&P 500, the 50 SMA will slowly creep up there. You're not getting as much confluence with the lower edge of the weekly expected move, of course, but that's not the end of the world. The biggest threat as we walk forward, now that we've sort of described how the trend is clearly weaker here, is that you don't even have to close this gap overhead for a daily lower high to form. I think it's very reasonable if we just add a little bit more price context. If this, generally speaking, is a balance range back here in this box, right? 500 represents the top end of that balance. Is it possible that the market comes in, sets a lower high under 500, and just rejects to keep us inside of that range? Absolutely. So 500 is that threat for a daily lower high until proven otherwise. To really get bullish here on the QQQ, I would want to see some interaction with the 50 SMA, some interaction here that's maybe like an intraday Brigade bull to look below and fail, something of the sorts around this. Let's just call out all of the levels, right? We have 490.50. Gap closes all the way at 492.50. Gap begins at 494.50. Some sort of buy-side setup around this that fails to go lower near the 50 SMA might be a decent opportunity for risk-reward along these lines. If you're going to look for the long, like let's just say that we support in here and rally out of the gates, I would tend to think that your only long trade with fairly well-defined risk, instead of just buying it arbitrarily in the zone, looks something like a gap close overhead. If you could get over 500, consolidate, and possibly break above, your risk might look something like this box right here, with reward to close the gap. In that case, that's absolutely a trade I would entertain because of the gap framework. However, when we get here, just like in the S&P 500, I would have to reevaluate, is it possible that the overhead supply looks trapped? And if we spot sellers there, still another opportunity for a lower high, in which case you could try it again to the downside for something that looks like this. Now, I would look for 500 to act as support in that instance. So let me come in with actually, let's take it to the hourly. I'll bring you all the paths here in just a second in terms of major trade ideas that I'm actually considering, right? So first and foremost, right, big trade. Well, let's rewind. I'm getting a little too excited about the pathing here. I do want to acknowledge once again the Jerome Powell afternoon nail in the coffin. This basically happened because Jerome Powell acknowledged we might not be in as much of a hurry to cut in December as the market was perceiving us to be, right? The 25 basis point cut. The market didn't like that very much. The market wants free money. The market wants ZERP again. So as we had talked about on the Wednesday midweek market update, we had look below and fail, look below and fail, look below and fail. The buyers had one final opportunity on Thursday. We opened at the level. There was an opportunity to rally and keep us over 512. It simply didn't take place. So I would say that the buyers failed in this instance, and it's really just an indication that new money momentum longs are not getting active here, right? This is a momentum breakout to the upside. This is consolidation where buyers who are chasing this move start to get trapped and are clearly getting hurt. So to me, it's not that new money sellers are aggressively getting involved in selling this market hard as of the Thursday close. To me, it's profit taking and sort of new money buyers just, long late to the party needing to close out. So does this look like new money sellers becomes the next thing. And to me, it's more of a liquidation break than slow and methodical selling all day. Slow and methodical selling all day probably has a similar range, but it's going to have much more give and take on the intraday, right? You're going to see more two-sided trade that allows price to come back to the VWAP, so on and so forth. You got a couple of VWAP tags here in the mid-morning session, but that was about it for the QQQ. Other than that, it was a straight shot lower. Once again, more of a liquidation break. So as I continue to evaluate the types of sellers that are getting involved, I wouldn't call it strong momentum, or maybe it's momentum sellers, but it's not strong sellers to the degree of, oh my goodness, market's going to flip into a weekly downtrend. We need to sell this thing aggressively. It's like, no, let's take some profits if you're long from this sort of gap up move. If you're long from down here, let's make sure we're not missing out on some of these profits. It's more liquidation break style selling. That's how it appears here on the hourly. So now that we've covered that, now we can get into the pathing. Now that we understand how this move has developed, generally the ideas are going to be as follows. One of the long ideas that we just sort of talked about is this right here. Back to the upside. Risk and reward. Something along those lines is absolutely bullish here. When we get here, we unfortunately have to reevaluate. It's even at 500. I would reevaluate some of this trade. Maybe that cuts the risk reward by a little bit. If we are going to get some sort of thin structure retracement early on in the week, this is probably difficult to capture. If we get this consolidation, the long trade that I would look for is probably this right here, which we had talked about on the daily. And then, of course, we have to reevaluate at that gap close. 508.25 is the level, right? So if this takes place, right, if we're seeing this, don't forget about the opportunity for a lower high here. If it's a double top, whatever it might be, then you're just looking to invert the risk reward back down to 500. From there, I would put my thinking cap on, because what do we know about the weekly chart? What do we know about the daily chart? Technically, these things are holding on by a thread to their uptrends, right? We're in a weekly uptrend, we're in a daily uptrend still. If this supports over 500, that to me would be a pretty clean-cut indication that we're trying to continue the trend in the upward direction potentially into the end of the year, right? We haven't even started talking about the Santa Claus rally yet. So those are some opportunities here in terms of risk reward and pathing ideas in the QQQ. Remember also, if this rejects 500, you might look for this here. You would have to see stronger sellers and then something that possibly comes in and closes the election gap all the way down towards this area, 492.50. So pretty comprehensive look there at the possible paths for the QQQ in terms of what we have risk reward wise, intraday anchored VWAPs. This is great confluence currently, so it won't really last into the beginning stages of the week. It's going to be there early Monday morning and likely continue lower. But that's currently at the gap close 508.25. These are sort of mixed up around that 500, so continuing to monitor this zone. It's a little bit of a tricky area. We'll come in here with the Fibonacci's from the bottom up to the top just to be congruent with what we did in the S&P. 38.2 is the previous all-time high. Remember that we fell underneath that. No semblance of support here. Stronger buyers probably would have bought this on the pullback to test that for the open up on the Friday morning session, at least providing some sort of gap close overhead. The fact that that didn't happen leads me to believe that, once again, you want to be a little bit more skeptical here in the QQQ versus the S&P 500. So still acknowledging that, yes, there is relative weakness out of this particular side of the market. If we come in from the top down to the bottom, once again, for congruency's sake, notice the 38.2618 confluence with the gap that we were just talking about, meaning that if we do get that rejection of 500, if we do get that rejection and no gap close overhead over 503.25, you are just getting bear flag consolidation underneath the Fibonacci 38.2, which keeps the sellers in short-term control. Let's drop this over to the NASDAQ market internals, see what's going on from this point of view. And what's the big difference, right? What is the big difference? What was the exercise that we did over on the S&P? Of course, what happened on Friday? You do have stronger sellers. What happened on Friday? You did get into trend lower zone. What happened with the cumulative build? And we're typically looking for 6K on the NASDAQ side of things, but let's not split hairs here. I mean, 5,900 into the close of that Friday session is definitely more bearish than what we saw over on the NYSE side. So is it possible that you want to look for shorts in the NASDAQ and longs in the S&P 500? I would say that the evidence would support that thesis. Let's come on over to the market profile, and it's a rinse and repeat, basically, of the S&P 500. Notice that you don't have as much of a poor high on that Wednesday session, but it is there. You're also getting a little bit of an excess low on Friday, but if value can build out here, if we can get a close early on in the week over value area high, it could be an indication that we're getting buyers to position at better prices. The only discrepancy, of course, is that this is not the previous all-time high retest. So I would really save the longs for the ES, for the S&P 500, save the shorts for the NASDAQ. It seems pretty clean cut to me in terms of that distribution between the two indices. Let's drop it on over to the IWM and see what's going on from this perspective. Weekly time frame chart to start, and then we'll move on down through the time frames as we typically do. Big reversal bar here in terms of the magnitude of the gap up on the Monday session, and then closing right at the breakout point, basically, from this, you could call it like a weekly ascending triangle of the sorts, right? So this is do or die level. It's all about this area around 226.63. We'll see this more cleanly on the daily chart with well-defined levels, but this level right here, I think it was 227 that we were using actually. That comes to mind as a nice easy round number. But 227, if we can hold up over that, great. I think that there's possibility for a weekly higher low to persevere from something, that perspective right here, but pretty sharp reversal out of the IWM in terms of candle structure. Once again, we'll keep it sort of status quo. Upper wick, a little bit more so than the lower wick on this instead of the inverse on the S&P and the NASDAQ. No gap fill reversal up here, deeper close, about the 50% mark. You are still getting the higher low and higher high on the bar-to-bar count. If we zoom out here, I do just want to keep us aware of where the previous all-time high is in general, right? This is a really long-term rounded base. I wouldn't quite go so far as to call it a cup and handle yet, but generally this all-time high, we're within striking distance, right? Or at least we were, I should say, before the reversal from last week. So, as long as this can stay over the top end of the weekly ascending triangle we were just describing, I would tend to think this is bullish consolidation, looking for new highs over time. A big component, of this analysis is going to depend on what the Fed does with interest rates and whether or not they cut aggressively as they said they were going to. If we do get a cut in December, small caps are really looking forward to that. And as we know, they are much more sensitive to the operating environment. Let's drop this over with we can go volume profile here is fine. We know that this is a major high volume node, so it's a key area that needs to hold. If we were to get back down underneath this huge high volume spike, which really stems from all of this consolidation post-sickness run-up, right, and recovery effort back there, if we were to drop underneath that, I think that you just have a huge opportunity for overhead supply to really persist and drive markets back to the downside. I'm probably thinking about a deeper retest of like 200 based on the top end of this balance range from back here. Not to be overly bearish, I'm just saying if we drop this level, things don't really look great from the higher time frame perspective anymore. What are we looking for? We want the weekly anchored VWAPs for small caps. And what we can see over here is that this is slowly creeping higher, but again, we don't want to go here. We really want to keep price over that 227. So let's finish it off then with the Fibonacci's from here to here. This is underneath. Obviously, we're still above. Let's come in from here up to here, right at it. So once again, pretty solid there around the rough area. 227, 225 is really what we need as weekly support. Let's drop this thing down to a daily time frame chart. Let's get a little bit more nuanced, a little bit more granular. Obviously, the pullback's much larger. We just acknowledge that on the weekly time frame chart. On the daily, you'll notice that the expected move here, it's a little bit more compressed, and the reasoning behind that, obviously, is just that Nvidia is not going to have as much influence over the small cap. So the upper bound is going to be at 233.60, the lower bound at 223.34. You are still getting, how should I frame this? You are getting much more of that election gap close. However, the gap was much larger in the IWM. And remember also that this line in the sand, it would be, that's the line in the sand for a reason, but the ideal level, I should say, and what I'm trying to gather my thoughts on, is this 227, right? So as of Friday's close, we're sort of right at that area. It would be great if the market just found buyers here out of small caps, could turn around and then get some sort of constructive move in the upward direction. One thing I'd be very open-minded to in small caps is a longer time frame pattern really starting to emerge here, right? We've seen this long-standing ascending triangle build out. There's nothing saying that this needs to put in a V-shaped recovery and instantly find itself trading back up here around 240. It's very possible that over time, maybe this builds out, right, a little bit lower. It does something like this over the span of the next couple of weeks. And, if IWM is going to build out a long-standing double bottom, fine, right? Fine. So as long as price is over 227, I would be more optimistic about the potential for a reversal to keep markets bullish. That would be a tailwind, constructive bullish tailwind for the S&P 500. And if we start to drop underneath it, it really becomes all about, okay, in this case, we do want to see a sharp reversal off of the gap fill reversal, gap close, I should say. We don't just want to see the gap close and then start meandering sideways down here. That would really set up lower, in my opinion. I would want to see Gap fill reversal, buyers step up, really sharp movement away from that, with then some sort of Brigade bolt perhaps over the 227. If that were to take place, this would certainly have me feeling more bullish and more constructive on the long side for the S&P 500. If the market is going to rally here out of small caps, I would say that your biggest hurdle is actually this 236. I know it's extended through the upper bound of the weekly expected move, but I wouldn't really be as concerned with this 232.75. I really think it's more about this. If we reject there, there's still an opportunity for a lower high, and you can see why on the hourly time frame chart. This is just a big thin structure breakdown, but this is where we start to see that's where your overhead supply steps in, right? You have left, head, right shoulder, neckline breakdown. So a retest of 236 is much more meaningful. If we were to set a lower high and firmly reject off of that, that probably doesn't feel as warm and fuzzy inside in terms of continuing to look at this from a bullish and long perspective. We'll come in here with the anchored view apps intraday. Again, early week confluence, they're probably not going to last there for a big portion of the week, but 236. This is a little bit more spread out here in terms of these. Ideally, this support. So once again, some interesting ideas might look like this. To get back higher, would reevaluate here just briefly, but more importantly, it's all about that 236, right? That's your upside. If this is going to come in, once again, pathing that looks like this is ideal. And even, if you don't want the double bottom here, that's fine. I would say that this could also stand, and that's exactly what we just described on the daily as well. 227, Brigade bolt, higher low above. If we quickly check in on the Fibonacci's from the top end to the bottom of this move, 38.2. I guess maybe for the amount of confluence we're getting there at the 232.75 area, maybe this is worth a little bit closer of a look as and if we see that move to the upside early on in the week. It's also the upper edge of the weekly expected move. So yeah, I take it back a little bit. 232.75, analysis in real time here is providing us with the answer that, yeah, you probably want to pay attention to that level with equal amount of importance. Coming from the lows up to the highs here, 38.2 is right there again. So all the more reason to continue paying attention. 61.8 is great confluence with that 227, reinforcing all the key levels that we've talked about so far. Let's come on over to the Rusty Russell market internal, see what we've got from this perspective. Stronger volume outflows, not as bad on the cumulative build here, not in trend lower zone on Friday. So not really I don't know. I'm a little bit more mixed here on the Russell. At this point, I would say that the long opportunity is very clearly in the S&P. The short opportunity is in the NASDAQ. And whatever the Russell decides to do intra-week relative to these levels that we've described as being very important here will help us determine whether or not we want to lean more heavily on the long or lean more heavily on the short, right? If the Russell is breaking down and closing this gap, we probably want to avoid the long in the S&P and at least try, or maybe not at least, it would be at least avoid the long in the S&P and maybe short the NASDAQ, right? If the Russell's rallying, we would probably want to, at minimum, avoid the short in the NASDAQ and maybe long the S&P 500, right? So that's generally how I'm thinking about this as an influence for what we do throughout the duration of this week. Let's bring it on home with the Rusty Russell market profile. Same commentary. No need to rehash everything. Poor low, very poor low. Value is certainly shifted lower. If we can get a close over value area high, I think it kicks things off as a possible hold of that 227 previous pivot high, weekly pivot high we were just describing on the daily chart. So with that, we will jump on into our sector analysis for the S&P 500. We'll zoom in over here so that's top of mind. Weekly performance, who was leading, who was losing, and where was the weight? You can certainly see energy outperforming here, up 1.02%. Then we have financials, 38 basis points, utilities, 8 basis points. Everything else in the red. The largest loser is the semiconductor ETF, down almost 7% preemptively to Nvidia earnings. We're going to take a deep dive on that in just a moment. We've got healthcare also falling off of a cliff, the third heaviest weight sector, getting beat up with the appointment, of course, of RFK. The healthcare sector is pretty worried about that, apparently. So we'll see what comes of it, but generally, we'll take that one step at a time. The technical chart is pretty ugly. The XLK, the tech sector, is down pretty bad, down 3.55% there, the heaviest weight top dog in the S&P 500. And then we have materials, really lightweight, a non-issue, down 3.27%. Let's check in on the structural charts and really get nitty-gritty about what we should and should not be paying attention to. Energy looks fine. Sideways here is fine. Pullback is fine. Continuation is fine. So we're moving along. Financial sector looks fantastic, to be honest with you. And this is really brings to the forefront the conversation we need to have about the possible new, not to get political here, but, if the market's pricing in an environment where merger and acquisition activity is going to increase substantially, then financial sector is going to be a huge beneficiary of that, of course, right? And a number of people are talking about this. So the market pricing that in, of course, would be bullish for the S&P 500. Now, what, of course, is the opposite side of the coin? Well, what's going on with the healthcare sector, right? And the healthcare sector, being the third heaviest weight, financial sector being the second heaviest weight, this big push and pull is going to act like, bucks ramming heads together, right? You have push and pull, tug of war, can't make up its mind. So what's going to be important this week to watch for is if financials start to break out to the upside and the healthcare sector can find its footing, we'll talk about that chart, which is falling off of a cliff, then great, you probably want to be long the S&P 500. If financials break down underneath this multi-day balance range low, it's a week-long balance range low, if we're under 49.60 and the XLV just remains sideways or even continues lower, that's where I would say, okay, you probably don't want the long in the S&P 500. So I think financials as a sector will be absolutely pivotal this week in terms of which way this balance range breaks out, right? You have over 50.10, probably bullish for the S&P, at least if the XLV can go sideways, or under, start to dial back some of those long ideas in the S&P 500 directly. I would say, the chart is clearly still in an uptrend. Obviously, this is a very bullish chart, but intra-week, you might experience some bearish headwinds if you're underneath looking at a pullback here in financials. So that's that. Utilities, not really an issue if it's higher grade, if it's lower grade, not the end of the world. Semiconductors, let's talk about it, right? So on the election news, right, and everything that was going on here, we finally got the recapture back above 256, the top end of this balance range back here. We were looking for an opportunity for the market to go sideways and then possibly lift to close the gap. That would have been the most bullish and constructive opportunity for semis to produce. Now, what has happened? It's been a straight shot lower, basically, with some real weakness on Nvidia into that Friday session. So generally speaking, being underneath this balance range now, remember, we were trying to move the goalpost inch by inch by inch and saying, like, okay, Nvidia's trying to hold on. It's maybe setting a daily higher low still. This is still a daily higher low here. Not that we can't do it anymore. Just can't do it anymore. So this as overhead supply now acts as a real threat on either, a rejection off of 245, a gap fill reversal slightly above that looks bearish here. Overhead supply weighs on this. Let's just say that we start to break down through the 200 SMA. There's not a whole lot holding us up here, this look becomes the threat, right? So 221 is a downside target. Now, am I like cheering for a big bearish breakdown? Not really. I'd personally not like to see that, but if it unfolds, then fine. We're just going to trade the chart in front of us, right? So what does the bearish pathing look like? Well, consolidation here, as you can see the little balance there, is continuing to reinforce the bear thesis, and I would be actively looking for shorts across the broad market if we're looking at a move underneath 230.80, right? Again, target here 221. If this is going to turn into a look below and fail, you've got to just do it again, like what we had here and then here with this acceleration. You need to recapture with acceptance 245. And even at that, I'd be more so neutral through here. At this point, I need semiconductors to prove it to me with consolidation and a clear higher low that then exceeds these equal highs. If that takes place, great. You'll hear me shouting from the rooftop, hey, we're bullish in semiconductors, probably bullish for the broad market. Unless that takes place, neutral. It might be intraday, intra-week bullish pressure if we're starting to get that lift. But generally speaking, it's got to really prove it. It's got to prove it. It's got to get out of this balance with acceptance if we're going to be shouting from the rooftops about it. Let's move this thing along. Here's the healthcare sector, which once again is, unfortunately or fortunately, depending on how you like the sound of my voice, is another sector that we have to spend some time on, falling off of a cliff here, of course, with the appointment of RFK. The poke makers, if you catch my drift, are absolutely shivering in their boots, if you will. If you look at names like mRNA, if you look at PFE, not really faring so well, and of course that's having a big impact on what's going on with the XLV. Even the insurance companies, right? UNH, for example, pulling back sharply even after this gap up on the election win, right? So generally speaking, that is what's going on in healthcare. That's sort of the logic behind it. And what's the big idea, right? The big idea just becomes this over time. And if this does take place, what does it spell for the S&P 500? Maybe the opportunity of a weekly trend change or weekly trend stagnation. We're not there yet, and I'd still lean on and rely on the SPY weekly time frame chart, but that is the higher time frame threat that's at least posed. I would not try to short this dead on the lows of the move. I think that this is, you never want to try to, there's a couple things you never want to do. You never want to try to catch the falling knife, but you also don't want to try to chase the falling knife. So barreling into this area of support around 140.80, again, one of the reasons why I continue to lean a little bit more, so you can probably hear it in my voice, on the long thesis for the S&P 500 is because if this is the bulk of the move for the healthcare sector as we come barreling into this support, if it can catch itself for a little bit of a footing, and if the financial sector can break out of that 5-day balance range, I think you're in the clear for the S&P 500. So watching this very closely at 140.80, just the bottom of this range, the top end of what we had going on over here. If we can support above that, I think we're okay in the S&P 500. XLK, the heaviest weight top dog for the S&P 500. Again, we've got to spend some time on it. Here's the balance range breaking down. The decent part about this is that you can still call for a higher low, right? It's still possible that you get a higher low on this gap close, 228, 227. If we can support around this, around the daily 50 SMA, I think we're okay for a ramp back up to the all-time high, just building out one of the most epic sort of ascending triangles, if you will, that we've seen in a very long time. So watching for that. If it fails, if it breaks through the 50 SMA, if we're getting acceptance underneath, we've got to call it, what it is, call a spade a spade. A failed higher low here gets pretty dangerous. Now we fall into weekly stagnation, daily stagnation, and of course that starts to be a bit of an issue for the S&P 500. So a couple of key things. Financials need to break out, healthcare needs to hold, even the tech sector needs to hold at the daily 50. We can speed round through the rest of them. Materials breaking down, we know here is a bearish headwind as it made a new pivot low. Let's move along to industrials, pulling back. This is still in a really solid uptrend here, so not as concerned. Gap fill reversal, still yields a higher low if it wants to consolidate here. Bullish, not a big deal. TLT, bonds. We'll have some interesting commentary on bonds when we talk about the Fed tracker tool and what's going on with interest rates, but generally bonds, excuse me, apologies, did break down here into the end of the week. After this substantial and sharp move to 93. So I think bonds have a little ways to go lower. I think you could easily be thinking about, around 88.15 previous lows from there. And for those of you who are following along on X, which is the old Twitter, of course, you can follow us there. The link is down below in the description of the video. But I actually am long some TLT through the lens of being short puts going out to December. So, I just sort of bring this up. And the other thing to bring up maybe is that I was buying some S&P 500 in the long term on the Friday session as well. The reason I bring this up is to maybe, not so much say, hey, look at me, what I'm doing. I'm just to sort of speak to the confidence I have in sort of the analysis that we're doing here. And again, sort of putting my money where my mouth is in terms of wanting to be a higher low pullback buyer. So I'm short TLT 85 puts for December, just of the sort of mindset here that if Jerome Powell is going to signal that maybe we don't get as many cuts, right? It's very possible that bonds don't like that, of course, which move them in the downward direction. Yields go higher. And then if we get the 25 basis point cut in December, what should happen, right? You should either get a sharp move. So assignment at 85 feels good to me, or if these things just expire worthless, that's fine as well. I'd be happy to be long some TLT from about 85. If you go to a weekly chart, you can see this as well. 85 is in between this, of course, is about 82. There's a long-standing base here. It doesn't mean that, the idea is not foolproof. It doesn't mean that TLT can't go lower because Matt's short put in it, but just generally that's the thought process there, all right? So that's the TLT. Let's move along to the XLY. Let's drop this thing back down to a daily time frame chart. And we will take a look here. Pulling back, I think this is an important one to watch. You have thin structure, of course. Amazon and Tesla really responsible for this rally over here. If this breaks underneath 212.50, there's kind of some room to fall. This could act as a headwind intra-week to the S&P 500, so you could add it onto your radar, but I still think that the financial sector is going to carry more weight. Let's move along to the real estate sector. No issues over here. We can move along, actually. Communications, looking for a higher low, gap fill reversal. This is a strong uptrend, very, very clean and strong uptrend, so not really worried about the structure of this chart currently. XLP looks fine on this pullback. Remember, this is D for defensive. It's also a lighter weight sector. If it makes a new pivot low, I'd be slightly concerned, but look left, there's this big chop zone back here, so is it going to do anything impressive? I don't really think so, personally, and if we are going to see a defensive rotation anyways, this would be one of those things that you would start to see outperform. So either way, not as concerned about this. It really boils down to that healthcare and financial sectors we were just talking about. Here's the ratio grid. If you're not familiar with the ratio grid, check out the video tutorial in the top right-hand corner. What do we see? This looks neutral. This absolutely looks risk on. This looks risk on over here. This is a non-issue, remembering that it's D for defensive anyways. This looks decent. I mean, it's not the heaviest weight sector, but it's not really risk off. This looks great as well, out of communications, holding and consolidating sideways after the massive rally higher. Not really seeing strong trend reversals out of consumer staples or utilities on a relative basis, so no major concerns in terms of risk off taking the dominant stance. It's simply not. If we take a look at this, yep, there are some pretty sharp reversals into the end of the week, but what is the name of the game? The name of the game is looking for higher lows, right? Charts do not move in a straight line. That trajectory is unsustainable here and here. So if we can spot higher lows, then great. all set. Still leans risk on. Still leans risk on. Still, this one's a little bit more hairy here. This is XLU relative to the XLK. A little bit more hairy, but you could still go lows, higher lows, higher lows. It would have been ideal if this held up over the previous pivot highs, but still hanging in there. This one looks great. This is discretionary versus staples. This is healthcare versus semiconductors. Still doing okay over here. The global markets still weakening, as you can see, continuing to advance to the downside. We talked about that on Wednesday. Not the end of the world for U.S. markets, but just something to have in your back pocket. Let's move along to the dollar, which just absolutely ramped and broke out into the end of the week. Really strong move here, should be putting pressure on equities, and it is starting to actually unfold that way. An interesting stat that I actually heard and was unaware of, so you learn something new every day. This comes from Michael Kramer over at Mott Capital. You can click him up if you're interested, but generally, a 1% increase in the dollar should yield a 50 basis point decrease in the earnings yield of the S&P 500, or forecasted earnings yield, right? So that was an interesting stat, something you can carry forward in your analysis as well. Obviously, with an instrument trading roughly around $100, you're just talking about every single dollar that moves higher here should be shaving off 50 bips, right? So making sense that you're seeing that pressure being added to the S&P 500 finally. It's been so divergent for a very long time. It looks like things are finally catching up now that Jerome Powell has sort of blessed the market, if you will, to move lower based on his commentary about December. Gold pulling back aggressively here. The ratio chart is also pulling back aggressively. One of the things that we've been making the comparison of recently is that it's not gold anymore. It's the digital gold. Bitcoin continuing to advance here into record highs on the breakout of the major monthly cup and handle. Still looking good. Pullback opportunities. Like the other thing to not forget about Bitcoin here is it's a volatile instrument. A 5% pullback, a 10% correction, or whatever would certainly be reasonable out of Bitcoin after this breakout, as long as it's over the breakout point in here, or even the previous highs around 73, all set out of the digital gold. Let's bring it back to interest rates, though, and talk about the TNX here. So the 10-year rate was right at the 43 mark here, which is 4.3 on the 10-year, into the beginning of the week, and it actually used that as support. So as we're thinking about what's generally happening here, the ideal outcome for market bulls to advance this rally would have been that this came underneath. Jerome Powell laid to bed any of the fears about no further rate cuts in the Thursday session, and the exact opposite happened, right? Jerome Powell said, no, we might actually take that off the table. We're not in any hurry to cut rates, right? We're just looking at the totality of the incoming data, as he typically says. So generally, that spurred rates to move higher, saying, okay, maybe Jerome Powell is listening to our message that inflation is going to come back and cause a little bit of an issue, right? So the TNX is sort of supportive of that idea, holding this for a higher low, continuing to pressure markets down there. So it's kind of funny how it works, but like almost once Jerome Powell gave the blessing to the market to move lower, you're starting to see that unfold. Now, again, I'm a believer that the technicals kind of drive things, and it was really more so an overhead balance range breakdown, but the excuse is that sellers finally got active, maybe perhaps because of Jerome Powell's commentary, right? So anyways, neither here nor there in terms of, we could argue all day long about what actually moves the market. At the end of the day, it's just orders hitting the order book, right? So the ZT inverted 2-year yield also moved slightly higher on this announcement from Powell. The Thursday bar is technically that second one in, slightly a little green bar there, but let's just take a look directly at the Fed tracker tool here and see what that has to tell us. This after the after the CPI on Wednesday went to a head-scratching 80+% odds of a cut, even as CPI came in sort of in line with expectations and elevated relative to the Fed's target. So that was a bit of a head-scratcher, but after the comments from Powell, much more into a 60-40 balance here for that December meeting. And I would imagine that the next major mover there is going to be your labor report early on in December to gauge whether or not the Fed needs to cut rates because there are massive layoffs. As of right now, the weekly jobless claims data, if we just take a look at this every Thursday, wouldn't really indicate that we have large issues, right? This was the weather event, and things have, easily settled back down beyond what we were getting prior. So I'm not really overly concerned about the labor market. We are seeing some anecdotal headlines. Remember, AMD announced laying off, 1% or was it 4% of the workforce? That equated to 1,000 workers or something like that. But that's something to keep an eye on. The other thing to keep an eye on here is, we're always wrapped up in what the current odds are for the next meeting. But generally speaking, if Jerome Powell is not in any hurry to cut rates, right, if this starts to move higher here, if this full column becomes shaded and we're only expecting maybe 2 more cuts, one in December, then one out to the early stages of 2025, that's also another way that the market could signal that financial conditions are going to stay at these more restrictive levels as Powell would potentially frame it. Let's jump on over to the calendar here and talk about CPI and inflation now. So at the expectations here on the month over month, really at expectations across the board. But one of the things that this does is if you take the let's jump to this one first. There we go. If you take the 6-month annualized rate, 12-month annualized rate, if you take the, which is the annual rate, if you take the 3-month annualized rate, what you'll notice here is that inflation is starting to look a little bit more like a bottom instead of continuing to trend in the downward direction. Notice that the 12-month, so just, year-over-year inflation is flat, slightly up from prior. The 3-month getting pretty volatile and clearly trending in the upward direction, and even the 6-month starting to flatten out here. This is much more of a flat look than what we've seen in these continued moves to the downside here and even earlier on in here. So any sort of uptick out of that starts to become a little bit more concerning. So is it possible that inflation, this is something we've talked about on the channel, right? Is it possible that inflation, at least on the CPI print, is finding more of a floor at 3% instead of the Fed's target at 2%? It certainly seems likely based on the way that this chart is developing based on the latest release. If we take a look at the PPI, right? So this is the producer price index. This also is signaling that inflation is possibly reaccelerating. Look at the movement happening here. Usually producer prices are just passed directly along to who? The consumer, of course. That's you and me paying higher prices across the board. One of the things that's beautiful about this call out is just that we can see services in blue is what's actually reaccelerating here. Services is the sticky side of inflation. You can clearly see the small delta of increase there, accounting for some of the month over month increase that we had seen. So that is that breakdown. What was that other sneaky little slide that we had in here? So income and expenditures from the U.S. government. Why is this important? Because the market's basically telling us that, with some of these, and this is just goes back to that sort of new administration idea we were talking about with the healthcare sector, financial sector. There's this Doge thing happening too, right? The Department of Government Efficiency. And with rates moving higher, it's basically screaming that, hey, you've got to make this happen or we're calling your bluff. If you look at the deficit here, you can see what it the difference between the two. You've got to make that up, right? And with the 10-year doing what it's doing, once again, I think it's a clear signal that the market doesn't really believe that the new administration is going to cut funding to a degree that maybe they're promising. So again, not to get political, but look at what the 10-year is doing. Think about what that means for a couple of things, what Jerome Powell does with interest rates. And again, these things should be independent, of course, but also how does the government buy bonds or how are they selling bonds to the Fed basically to collect income? Right? That's a very, very interesting topic here with a deficit around this number with the promise, again, from a new administration that we're going to cut spending aggressively. So things that are top of mind for the market here as we're really peeling through some of the fundamental data. Let's take a look at the retail sales were sort of a non-issue on Friday. It was more about the continuation of the Fed breakdown from Thursday. I would argue that there's really a quiet week upcoming. There's maybe building permits just from the cyclical side of the economy could be interesting. Unemployment claims on Thursday, the usual stuff. Manufacturing and services PMIs on Friday, but the flash number, the ISM numbers are usually more important. So we're all set on the calendar. Let's take a look at the earnings. This is what I want to point out from this perspective is that you're finally starting to see a flattening out of the projected bottom-up estimates, right? You can see that we're flattening out on what's left of the 2025, the 2025 is flattening, if not trying to find a higher low there, and we have flattened completely for what's left of the 2024. Now, it doesn't mean that we can't see these things taper off into the future here, but this is very important that they're at least not trending lower as you're getting let's scroll down, as you're getting a PE multiple that is expanding in the upward direction with a US 10-year that's also accelerating in the upward direction. Can you kind of see what's happening, right? From a fundamental valuation perspective, you need those earnings estimates to be really strong if 10 years is going to continue to accelerate, because otherwise anything that looks like this and you get a big old ouch for the market. So fundamentally, I think all of this ties into the conversation we've been having about what the market expects from the future here, and it's really just the issue is the interest rates right now. Interest rates, the 10-year, the market is clearly sort of ignoring that, and the rooster is going to come home to roost at some point is my belief. I'd prefer if we saw a better correction out of the 10-year and we sort of move away from that thesis, but that's currently the state of the affairs. So Fundamental takeover from Matt. We can just look forward to the earnings calendar. Of course, as we mentioned in the intro, it's all about Nvidia. There's a massive call wall at 150, and that will be very telling whether or not the Nvidia can make it through all-time highs with a massive beat and raise again. We shall see. So watching out for that. Some honorable mentions. Look at that, Powell. He's got his own company. No, in all seriousness, some honorable mentions here might be something like Walmart, Lowe's, cyclical, right? Think that way. You could look at Target, of course, is probably going to be on the heels of Walmart, so not a big deal there. Snowflake, Palo Alto, cloud stuff, right? What else do we have here? So, Alibaba sort of set the tone for the Chinese companies on Friday. BJ's consumer spend, perhaps. And that's really it. It's really it out of this week. It's all eyes on Nvidia, clearly. We'll talk about the options implied volatility there as well in just a brief moment. Back on over to the platform. Let's finish up the analysis here by going through the other supporting evidence. TLT ratio to the S&P is seeing a little uptick into the end of the week, but really no big deal overall. If we look at bonds relative to themselves, in terms of durations, still thinking that inflation wave 2 is going to be an issue. That's why these shorter yields are getting the uptick, of course. If we look at the credit spreads, they are seeing we talked about this on Wednesday, actually. Wednesday is when the majority of that uptick took place, kind of flat into the end of the week. Once again, these are still in long-standing downtrends here and here. I wouldn't be overly concerned from a volatility perspective. It still looks more risk-on than it does off. If we take a look at the junk bonds in isolation, it's sort of called the bluff of the market here with that bearish divergence, making the correction here. It's all about whether or not this to this holds as a higher low and whether or not we see the same thing here out of the HYG. So continuing to monitor that. I'll bring you updates as we see that develop. We looked at Bitcoin already, so we can move into breadth. Breadth did weaken this week by moving in the downward direction, not through the zero line yet meaningfully. So I would continue to keep close tabs on what we've got here out of new highs versus lows. If this meaningfully goes negative after a lower high in this moving average chart, that might be a little bit more of a concern, but we're just not there yet. Still leaning on the bull side of the market. Let's jump on over to the RSP. So another breadth look here. Not holding up over the previous high, whereas the S&P weighted currently is. This might be an indication that, you probably are in store for a little bit more of that gap close and potentially a reversal off of that. If we could hold up over this level, that would be really ideal. That's 179.35 in your RSP. If we look at the QQQE, this is moving much more in tandem with what we have in the weighted, so no issues there. What about the Dow, though? Because this was actually a really decent confluence, like finally getting this breakout in transports. You're getting a little bit of a consolidation up here, but not an aggressive pullback. Certainly no big fake out to look, like acceptance underneath 16,150. If that were to take place, then my goodness, that would be sort of like a Armageddon style signal from the Dow, but we're just not there yet. So all set here on transports versus industrials, once again, keeping me a little bit more optimistic perhaps about that S&P 500 looking for a higher low. If we're looking at volatility, a little bit of a floor here off the 15 level on Friday, but generally lower after the election makes sense. This is what I mean there, and looking for that to continue to deteriorate. The only thing that could spice that up is if Nvidia really kicks off. It's like if it's the first domino that falls to a larger downdraft, that could be interesting, but I would not make that assessment purely based on the VIX chart itself. If you look at volatility of volatility, it is rejecting in that upper wick, right, the 103 level. So if this can all act, and you wouldn't do a classic analysis like this on this, but if it's just a lower high, generally the sentiment about volatility is that things are cooling off. It's a better opportunity to invest basically in the market if volatility is settling out. We could see the same thing here on VIX futures, right? Sharp pullback, but generally still over the zero line means that we are in a contango, which is a great time for market managers basically to allocate capital into the market. Same thing here out of the 30-day versus 9-day VIX, month versus 9, and then you have the 1-day VIX, pretty compressed as well. So no big issues out of volatility. If this starts to reaccelerate, like if we find ourselves back down over here, you'll hear me start waving the white flag and saying like, hey, maybe it's not such a good idea to buy this pullback. In terms of the short term, I still think the long-term opportunity is absolutely there as long as the weekly chart remains up. Let's take a look at the core list of companies, and then I've got two additional trade ideas for you. So Apple's going to kick things off. What do we see here? Really sloppy and lackluster chart. The only thing that we can sort of lean into is the opportunity for a look below and fail. If price can stay over 223.75, I think we're okay, but it's been really sloppy. Really sloppy in here. So 223.75, did I say 50? 223.75 is your key hold. If we're above it, ultimately looking for risk reward along these lines. That's generally the range that we're trying to exploit. The best trade or the better trade would look something like this for a rotation back to the origin of the breakdown level at 233. That's a higher low over 229.50. If price gets underneath 223.75, call it for what it is, right? Maybe this is just a good old head and shoulders. Underneath the neckline, the door is open for some of these downside levels. 217.25, 214 is also an opportunity. Here it is on the hourly time frame chart. just to illustrate, again, the sloppy nature of what's been going on here. It was a decent little double bottom breakout happening here, but the lack of sort of hold of this stair step higher, just kind of sloppy and back underneath the main neckline in the first place of that double bottom. So not really interested in short-term Apple ideas. It would need to set something up around these levels we've been describing so far. Microsoft, what's going on with Softy? It's really just stuck in a balance range, right? This is your general balance range. Made a little bit of an attempt to the top end, but not really accelerating aggressively. You're currently just in a micro balance inside of the balance. Microsoft, micro balance. There we go. We've got 415. If we can hold 415, great. I think that the buyers are trying to make a little bit of a something out of it, staying over this balance range here, but generally under 415. And you're talking about double top, lower highs, rotation to the bottom end at 408. So how would I want to trade this? If this wants to turn into an inverted head and shoulders, then great. I'll maybe take it in the long direction like that. Reward, and then risk in this box. That would be awesome. If it just accepts down here, then I would probably just, avoid until it breaks from its daily range. If we could get a break through those equal lows, I think it's a much more exciting opportunity for larger downside to actually unfold. Right? I wouldn't want to be directly short into resistance. I would want to see the break, Brigade bolt underneath, and then the door is open for those larger targets. Next up, Nvidia, the one stock to rule them all, and we've got to take a look at the earnings, or at least implied volatility, option selling data. Let's take a look. Let's throw this on, and let's apply. And we'll see what's going on here. So this will be, I talked about this in the beginning of earnings season, but I think it's worth reinforcing. Nvidia's IV is currently at a 62. Relative to the year, it's pretty low, but I do believe that IV is just going to crush here and move right back in the downward direction on the release of earnings. So if you're buying calls, if you're buying puts outright, you need a pretty lofty move to ultimately have this pay you. If you look at the current expected move for the week, we're talking about a plus or minus 1619 move on earnings in particular. We're dealing with about 1443. So generally, you're going to need a substantial move. So current price is where? Last trade is at 141.90. Let's call it 142 plus 14, right? You're looking at a move well over 150 if you're going to get paid on the call side, or a move well under, let's say like 25, give or take, to the downside there, just for round numbers sake. So if this is really going to go for it, you can just sort of see what's, sorry, did I say 125? Not quite 125. But it's going to need a substantial move there for that to really pay. 125? My mental math is not there right now. So why does this matter? Why does this matter? Because Nvidia is going to drive what the SMH does, right? And what is the SMH going to drive? The SMH is likely going to drive what the QQQ does, or it's going to drive what the XLK does, which is going to have some impact on the S&P 500. So if there's a huge call wall here at 150, and we just saw that the expected move is maybe above that from an earnings perspective, there needs to be a big beat and raise here to the upside if you're going to get above where basically market makers are hedged from. If we stay below 150, what does that mean? Well, anybody who's short up here on the wrong side of the options chain is going to need to do what? Sell stock to avoid their hedge, or unwind the hedge basically. So if 150 is not breached on earnings, I think we're in for a little bit of pain here in the S&P 500 and the NASDAQ. So this is why in the intro, I really tried to make a point that Nvidia is going to be a big pivotal moment for the market this week. And we can just see that, right? If I go out to the trade tab here again, if you look at the open interest on the 150 call, let's grab a little bit more here. Let's go to the open interest on the 150s. You can see the size that's there, right? There's your 165,000 contracts versus, hardly any of that on the below side. Just a little bit to the upside. You're seeing another one at 155, which is a little bit more so in line with the market maker expected move anyways. I'm curious to see what was the actual sizzle on the Friday session. You didn't have people. You had some hedging take place into the Friday, but nothing aggressive here out of the sizzles. So anyhow, little brief, deeper dive out of Nvidia in terms of the options market and what it's sort of signaling to us on the analysis. 150. If we're below on earnings, think about it unwinding. Right. That's the bottom line up front. Think about it unwinding under 150. On earnings. That's Wednesday after the close. So in terms of analysis, I'm going to be pretty hard pressed to be trading this with elevated IV into the early stages of this week. I'm interested in maybe trading the back half, end of day Thursday, Friday morning. So we'll see how that starts to unfold. But generally speaking, you have overhead supply weighing on the market. We did get a gap close here, and the buyers did start to respond to that 140.25. So early on in the week, what I would look for if you are hell-bent on trading this thing is possible lower highs under 144.42, or if we get back above, now you're talking about an all-time high rotation. That would be off of the gap fill reversal, but the only way to manage risk there would be if we can get back above for that rotation right there. That's Nvidia. Next up is GOOGL. What do we see out of the Goog? coming in for another round trip, right? There's your retracement of the earnings gap, right back to the upside, right back to the downside. So be my guest if you want to trade Google. It's been a pretty sporadic and volatile one recently, but generally, excuse me for the sniffle, you guys who tuned in on Friday know that I'm slightly under the weather here from that pre-market prep episode. But 169, if it can continue to hold, I think we're okay. I would just start treating this as a general balance range. If we can support off of it, great. Range rotation, thin structure rotation, absolutely. Let's drop it down to the hourly. Let's see what we can see. Major level would just be right here at 174.75. If we can rally and reject, great. Lower high sort of keeps the bearish pressure on. I would start to really change my tone more aggressively if we're under 169 out of Google. If it rallies to recapture that, then I would be on board for that sort of rotation to the top end. 180.95 would be the level with respect as well to 178.25 there. Let's drop it on over to Amazon. What's going on with Nancy? Really, really sharp pullback into the end of the week happening here on the gap and go underneath this, retracing the thin structure, but to where? Right into the previous all-time high. I'm more interested in finding longs on Amazon than anything else. If we could support via some sort of inverted head and shoulders, left head, right. If we could support via some sort of double bottom, 1-2 neckline break, great. I'm really looking for the long here on the hold of $200.25. And the target would firstly have to be this zone, but ideally continuation would look something like this, back to the highs, right? Really interested in the daily, finding a higher low over the previous all-time high, $200.25. Pretty clear on that one. The metaverse. Breaking down from the overhead supply, got to call it for what it is. Retest of the weekly breakout area looks really interesting to me. Previous all-time high here, 542.50. If we can make it there, I'd be interested in long opportunities off of these highs. Yes, you have overhead supply, but if the buyers step up, and again, the thing here, guys, is that you're not just like setting limit orders, hoping they get hit, and then there's a reversal. You're looking for intraday. Do you print some sort of hammer? Do you print some sort of, double bottom? Do you see on, order flow or level 2 time and sales, buyers being aggressive around this area? And if so, then great. We want to start thinking about longs here for opportunities that do this back towards the high, right? That would be the ideal outcome. Now, of course, that would require a swing, but that's the range that we're looking to exploit off of Meta at 542.50. So that to me is interesting here as an opportunity. I would not be aggressively short into this level. Next up, we have Tesla. Almost becoming the one stock to rule them all with this massive rally to the upside. This really requires the hourly chart just to sort of show you that you've got some better interactions up here now that a couple of days have passed, but this is really thin structure. I wouldn't put too much emphasis on the 299 or the 289.50. They're levels that you can carry forward. It is what we have to be dealing with if there's a larger breakdown of 312, but just understand that they're not the strongest levels in the world, right? If we were to hold this, where would I want to be long? Right here. You have a daily higher low that presents itself. You have an hourly higher low here, right? Equal, neckline, double bottom. You could even start to imagine it like that. Over 325.15, I think the trend, this is just a very classic what? There's a bull flag, right? So if we can get holds of 312, then great. Just to go back out to the daily time frame chart and give you some perspective here, really, really substantial rally. Let's just throw on the fib for the sake of throwing on the fib from the bottom to the top. 312 is near the 38.2, but remember the 61.8 is always the line in the sand, and that's the best confluence with these previous pivot highs, which is in the midpoint of a gap range, but we're talking about 267, roughly 268, 270 perhaps, if you want to use round numbers on Tesla. So there's some room to pull back. It's okay if Tesla pulls back. I think the chart is still being dominated from the buyers on the daily time frame chart. It's a matter of finding an entry that makes sense from a risk-reward perspective up here, right? Is this just the mild pullback that we're going to get? Is it going to accelerate? Once again, you would need to see that acceptance over 325.15. JP Morgan. Nothing to talk about over here. Balance range. Remember the XLF. Remember the conversation we had there. Screenshot this. Take the levels if you'd like, but not much commentary there. Netflix. I think it's time for a pullback. It's the first time, right? So we've had, let's actually go back to the daily. We had 1, 2, 3, 4, 5 days of substantial rally, which aligns beautifully with all of the other instances we had talked about from in here. 1, 2, 3, 4, maybe 5. In here you had, once it started going, 1, 2, 3, 4, 5 days of continuation, and we just got our 5 days to the upside there. So not that we're counting candles, not that that's how you should trade, but generally that's the personality of Netflix, and we are underneath a key level, right? You can see here, this was representative of the Thursday consolidation. Bear flag happening on the intraday below on Friday with thin structure to retrace underneath. The ideal thing to watch for, in my opinion, would be something around 797.65. If we could support over this, intraday resistance then acted as support intraday there to solidify that a little bit more so as a daily higher low, I'd be looking for re-entry longs around that area if you're not already long Netflix looking for this continuation. So those are your levels. Those are the numbers. Any consolidation up here, this is a really higher low, and then we're just looking for new blue sky territories. I would have to change my tone out of Netflix only if there's acceptance underneath 772. Is that going to happen? I don't know. I don't think so. At least not right now. Not this week. That would not be a primary outcome. I know that there were some issues with the streaming of the fight, between Logan Paul and Mike Tyson, of course. So maybe there's some intraday bearish activity as a response to that on Monday, but I would not be aggressively short Netflix in the monster uptrend that it's in. If it's underneath 772, we'll change our tone, but not yet. AMD, it's been a little bit of a trash stock recently. It has moved nicely underneath this little equal low from the past. So if you're interested in trading AMD, here are some levels, but Nvidia has acted as the top dog from the semiconductor space in terms of ease of trade. Nvidia has been a much easier trader. So there's that. I would say generally speaking, this chart is bearish, but it is sitting on a lower low. Do you want to be short in the hole? Probably not. Generally, what the idea here would be is set a lower high underneath the daily 140.75 and then look for continuation in the downward direction, right? I would have to change my tone. If this eventually built out as an inverted head and shoulders, I would change my tone maybe up and over the forecasted neckline, which would be closer to 147.50, All right, 2 trade ideas, and then you're on your way. AMAT reported earnings into the end of the week, and the daily chart is staggering. Look at this, overhead supply. Look at this, inverted hammer on the earnings gap down, rallying to reject right off of these previous lows. So generally, I think that this paired with Nvidia's earnings on Wednesday after the close with the potential to go sour based on the 150 call wall we were just describing. Generally, if semiconductors see some give back here, and even from a weekly perspective, you might say something like left head, right shoulder. Now that we're accepting underneath that, again, the point is not to chase it short directly into the lows right here, but it absolutely looks like bearish pressure for the semiconductor space. So watching that, if we're under 174, thinking about headwinds for the market. That's Applied Materials as a little bit of an isolated opportunity in the semi space. And then next up, we have Shopify in case we need long, so ticker SHOP. On a huge break, earnings, of course, to the upside. But most importantly, and you guys know me for this, right, is the nuanced takes of what happens when you sweep lows, come back into a range or something of the sorts. Earnings gap up is phenomenal, right? Huge move to the upside, inverted hammer on the day. The following session closes over its high, pull back. We establish this 3-day balance. Great. On Friday, and keep in mind what the broad market did on Friday. The broad market gapped and gap and go to the downside. Big downside pressure, even across tech, right? More explicitly across tech. What did Shopify do? It opened on a gap down. It looked underneath the 2-day lows, the earnings low, and then rallied to do what? Close basically at the gap close. So I believe this is the possibility of a look below and fail. Brigade bolt here rotates to the top end of the range. If we could trade from roughly 106 to 114, I think we have a long opportunity on our hands. Any price acceptance here, long over the hammer high, looking for, again, generally risk, reward. That might be something like a 2-to-1. It would be best if we had some better intraday opportunity, risk, reward, something along these lines, closer to a 2.5-to-1, this is the general premise of the range that we're trying to exploit. It's up to you intraday to spot that trade that works for you and generally, how you want to get involved in the idea and the thesis. There it is again. Sweep the lows, come back in, close the day strong on the gap close, basically. So very interested in Shopify. And that's going to do it for today's episode of the Weekly Watch List, our weekend edition analysis. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a big old thumbs up. Those go a long way to support the show. Don't forget, we will be live on a Monday morning for the pre-market prep, kicking off here on the channel at 8 a.m. Eastern Time. We hope to see you there. Should be a fun week's worth of trade with Nvidia reporting earnings and a lot of market participants on edge with this pullback that started to develop. With that said, I wish you a green trading week, and I will see you in the next one.